everybody, welcome back to Economica. Very happy to be with you all today, and I'm fresh back from a very long, never-ending work, working on data, UK macroeconomic data. And as usual, I have very interesting content today, so if you can watch the video, drop a like, whatever you want to do, I don't mind. And as you can see here, I'm sharing with you my screen. I have some forecast models and some other macroeconomic models. I will try to explain more or less in which sort of patch the UK economy is around the middle of the year, going from Q2 and Q3. We are waiting for the second quarter data. We have been seeing the latest month-on-month data, like such as declining GDP or rising inflation, and so some question marks have been coming up, as such as, is the UK economy slowing down? Are there any other issues that probably needs to have to be repaired somehow? Does fiscal policy has to be adjusted, economic policy? That's all stuff that will come up into the October budget. And before everything, I want to show you something that among the many tables of data that I've been analyzing and going through, I want to add another factor or rationale to the employer national insurance contribution hike. So here we see that we have so many strings of balance sheet data recording, so current taxes, receivables, payables from the general government. Okay, that's the main aggregates of general government. That's one of the many Excel tables that are compiled by the ONS. And we see in this table, we can see how much the government consumes, what has been the trend from 1990 up to 2024. And what among the many things that I saw, here at this 57 row, net social contribution receivables. So it's the aggregate of the national insurance contribution receivables, whether it's from employers or it's from households or it's some other kinds of receivables. So the aggregate, when we go fast forward to 2023, 2024, we see that basically the exchequer, the treasury, has received, has collected the same amount, or 230 billion pounds, 770 million in 2023, and 230 billion, 700 million in 2024. So in 2024, we already have a slight decrease in the cash flow receivables of 66 million. So among the many factors which are which go all together with the idea of having a budget, a fiscal policy, and an economic policy for the whole of the economy, I have to, for my own research, I have to take into account also this data, and I see that basically the overall aggregate of contribution, welfare state contribution receivables has been the same amount for 2 years in a row. So that tells me, or makes me, it's the deduction that I do, it's that probably the government, because you have a shortfall from 2023 to 2024 of 66 million. So actually the amount was slightly going down. So the government had to force through a hike from going from 13.8 to 15% in order to generate more cash flow. Now that's, that increase of the employer national insurance contribution, on one end can basically tampon the or just create a patch on a hole that is spilling water everywhere, for just gaining more cash flow, or just not to to lose too much liquidity of the system. But in order to generate more receivables, I think in the treasury they did something like 1 + 1 = 2. If 2 years in a row we are stuck with the same amount of receivables, we need to hike the rate of tax in order that we can automatically generate more receivables. That is not always the case, especially in a dynamic economy, because when you measure the cash flow on a static perspective, you have that amount of payers that you apply. Instead of 13.8, you change the variable, you change it at 15%, then on a static equation you have a larger amount. But because the economy is a dynamic environment, and the famous Laffer curve that everybody likes to to talk about. So you start to have less receivables already at the older national insurance contribution rate for employees. So that's something that a reference point that I took as a point of building a framework of data for the overall macroeconomic picture. So I can tell you, for example, that the final consumption expenditure of the general government into the economy has grown exponentially, especially in the post-COVID years. We are at 599 billion. So that's not an exception. I mean, the UK is not an outlier, especially since after the 2020 pandemic, the general bureaucracy of governments has been expanding, and the number of workforce that has been employed by government has been expanding. So central banks have, who more or less has been grappling with the persistent fiscal deficit, which seem to be unsustainable. That's also the case for the US economy, and the capacity, the liquidity availability in the bond market to absorb those kind of persistent fiscal deficit. So that's why we see that the UK gilt yield curve, the sovereign debt yield curve, is particularly steepened to the long end duration, and it requires particularly some higher yields, which is not great. The same is for the treasury yield curve. So slowly I'll try to put all the data together, although it's very difficult. So forgive me if I make some mistake or I forget something, but I have some good news for why there is a case for the Bank of England to reduce the bank rate, because the economy is slowing down. But here, for example, on this table, we can see that in 1990, government consumption was 109 billion, and in 2024, we are at 599 billion, 600 billion. So the consumption of the government has increased exponentially, and that's because the government requires more and more people to work for them, and requires more and more inputs for providing public services, so forth and so on. So now, not to be boring, what we can see here at the bottom of the table, we have total expenditures in millions of pounds and total revenue. Okay, so with a simple Excel magic formula, we do revenue minus expenditures, and we have the surplus or deficit. Now we can see that from 1990 up to 2024, basically as many other governments like Japan or Italy, Spain, the Euro area, the United States, Argentina, there is a persistent deficit. Now, why many people or many commentators, they go crazy about deficit? I'm not saying that people should, like the Chancellor of the Exchequer, should make a deficit like there is no tomorrow, but whether we like it or not, we live it in a system where the money supply needs to be created, and the economic and financial system that we have at the very start requires that there is issuance of debt instruments in order to generate the money supply, whether it's sovereign debt or whether it's private debt, I don't know, corporate debt or mortgages. Okay, so that's how the system works. So, and maybe some other funny person will tell me, okay, it's a debt Ponzi scheme. Okay, let's not go into that rabbit hole for the moment, but yeah, for sure, it's a debt Ponzi scheme. That's now, unfortunately, that's how it works the world. But we have deficit, so that means that the government makes deficit, though it generates money supply from the public sector. Because it's very important to distinguish, to make a distinguish for the money supply that comes from the public sector and the money supply that comes from the private sector, so from the private banks. So those are two different kinds of money. And then there is a third kind of money, which is the quantitative easing, which are only bank reserves, and those are only stuck into the financial system. So the government tries to make some deficits in order to help citizens and to provide services. What did I see? That the UK managed for 3 years in a row since 1990 to achieve a fiscal surplus. That was in 1999, 2000, and 2001. Then after the year 2000, we had the dot-com bubble, and the economy went into a slight recession because the asset bubble deflated, and so we had a recession. But it's not the case that you have a fiscal surplus during the year 2000, because when there is a by a dynamic general equilibria, dynamic stochastic general equilibria of New Keynesian macroeconomic. When there is a technological improvement, you have an expansion of GDP growth, and that basically provides more tax money income, and then you can generate the surplus. Now we have a problem that we have, for example, this magical artificial intelligence improvement, but we have not seen a jump in productivity, and so the technological shock, it hasn't produced a dramatical improvement in productivity, so that we see sustained organic economic growth. So by this time we are in a bit of a pickle, because the same as the year 2000 dot-com bubble, we would expect a dramatic improvement in productivity, then it all bubbled up in a bubble. The same, it could be considered the asset bubble that has built up for more than a decade, and now we have artificial intelligence, and of course artificial intelligence doesn't produce lasagna or wine or cakes or cheese, and so we haven't seen the necessary technological improvement shock into the overall DSG framework, a dynamic stochastic general equilibrium framework that provides a rapid improvement in economic growth, in economic output, in aggregate supply. Okay, so that's why from the financial market standpoint, I think always be very careful, because the stock prices, they are really bloated to very exaggerated level, while the economy, the UK economy has been slowing down, unemployment has been going up also in the United States, we have tariffs, there are so many factors that make you understand bit by bit probably artificial intelligence is a bit of a bubble, because we actually don't see this magic economic growth and total productivity factors improvement into the economy. So that's why, and the fiscal policy balances of many economies are not in a great shape. So we don't have this dramatic boon of good and miracle from AI. It's not like that. So that's another component to understand the overall framework where we are moving in. When we go into the rabbit hole, we have to take into account that, okay, AI, it's okay, we can use it, but we don't have a total factor productivity improvement. We haven't seen the economy growing very organically, so there are some friction in the system. Now, to be fair with the new government in the UK, and I don't want to I don't want to say bad things about the past governments, because every government has to make fiscal deficit, whether it's in Britain or in France, in Italy, in Greece. It's unfortunately, that's the system that they have to deal with. Okay, so here I managed to sum up the deficit that the government has generated since 2010 up to 2024, and I was very careful to take the deficit in 2024 and multiply by 7 over 12. So I only accounted for these first 7 months of 2024. And so why I did that? Because basically another issue in the overall global economic system, in advanced economy, is that we have lived through a long decade and more of zero lower bound interest rate and quantitative easing. So it was very, very easy for the government to do a lot of deficit, because the real cost of debt was negative. What I'm saying with that, most of you, I believe, I'm sure they know already what I'm trying to say now, if the calculator works. Okay, let's say we borrow at 1%, we have inflation at 1%, and we have GDP growth at 1%. So the real rate of borrowing, it's the real yield of the gilts debt or treasuries is -1, is -1%. So the real yield is negative. So the real cost of servicing the debt, it's negative. So it means that you are borrowing, you are paid to borrow in a certain sense, but it's not that way, because then what has happened is that we have an inflationary shock, and then you have episodes like the Silicon Valley Bank, or you have the LDI crisis. So when banks are exposed to debt securities that they bought at a premium with very low interest rate, and then the interest rate goes up, the price of the bond dramatically goes down, and basically the funds, they are in a bit of a difficult position, so far as that banks in California have shut down, have gone bust, because the most important asset reserve for banks are treasuries. So if you go into a negative reserve or negative value of your reserve vis-a-vis the deposits that you hold with your customers, when it comes to holding treasuries at market value, then it's a huge problem. The bank basically is bust. So since 2010, after the great financial crisis, we have quantitative easing, this magic way of monetizing public debt. And we see that year after year after year, the government has produced a lot of deficit. In total, at least for this Excel table, it's 1,750,549,000,000 pounds. That spread as an average across 14 years, it's 125 billion. I have to say, okay, yes, 2024 has closed with 170 billion. The past week we saw that the people who are in charge now, they've been over borrowing by 22 billion more with respect what was their forecast or their intention of containing borrowing. So basically in the past decade or more than a decade, there has been an accumulation of deficits. And so now to manage the UK public finances is a bit more difficult, because we are almost at the psychological threshold of 100% debt to GDP. And it's difficult, especially when you have basically consumption that it's gone to 600 billion. Government consumption has been growing to 600 billion. You have a lot larger welfare bill, a lot larger healthcare bill to pay, which are direct consequences of the global pandemic issue, that vis-a-vis the same level of revenues. And you would like to do some public investment. I don't know, that's not my choice, but in all circumstances, it seems very, very evident to me that if you want to balance an economy, you'll have to try to reduce spending, because if you're spending more than you are taking in, you will be persistently in a fiscal deficit. So now we have seen together that the amount of debt that has been accumulated, we are north of 1 trillion. So it's very difficult to manage this kind of situation and say, okay, overnight I'm going to put the debt to GDP ratio on a downward sloping path. We're going to pay off our debt. I'm going to balance the budget and have a budget primary account which covers the interest rate expenditure. So because also the another component of the UK economy is the increasing cost of servicing the debt. Okay, so because the average cost of servicing the debt was around 30 billion, now has grown to more than 80 billion, and eventually, I hope not, but with higher inflation, then you are exposed to long duration interest rates, long duration bonds. They are exposed to rising costs. So it's kind of a difficult situation to balance. It won't happen overnight, but from what is my humble research, my humble knowledge, and what is widely accepted, the most useful thing to do is to reduce spending. Like, for example, to argue for a department expenditure limit. We can set a 2% gross expenditure limit for every government department, so that there is a limit to how much they can go over their budget by 2%. So there are many things for which I'm not in the position to choose, or I do my research because I really like it. I have been studying the UK economy for a long time. It's been a very long, hard work, and I do it also for to understand better economics and stuff like that. So now, taking this wider picture is a partial idea, but we see that in the past 30 years, 35 years, we have a constant rate of deficit. We have 3 years only, 1999, year 2000, 2001, with fiscal surpluses, and it's not a coincidence, because a technological shock by economic theory, widely accepted economic theory as a dynamic stochastic general equilibrium models, they explain that technological improvements, it enhances the productivity factors in the economy, so you have more economic growth, you have more tax revenues vis-a-vis the same level of inputs that you put into the economy. So for the same level of spending, you have a higher GDP, you have more tax, then you have more revenues, so you have a fiscal surplus. And I've said, and I repeat it again, that we are in the AI bubble, because I don't see governments that are able to manage achieving a fiscal surplus. So all the artificial intelligence bubble, basically it hasn't provided a shock, a positive shock in the technological factor of productivity in the economy. And so what basically is the outcome is that if the economy doesn't improve in productivity and in economic growth, then it will come to the point that central banks will have finally to admit, okay, we have an asset bubble because we have persistent inflation above the 2% target, and we don't see better living standards or better productivity. Sometimes we see stagnation, we see rising unemployment, so there is an asset bubble basically. And then what will be, I don't mind. But anyway, so let's take stock of the fact that we, in 2024, the incoming government doesn't start from a very easy set of circumstances. But then what to do? Cut spending. Okay, I don't mind about that. What I'm gonna show you now, because what to do, I will do another video explaining explaining in as much details as possible what would be my economic framework that I would apply to the UK economy. And I will show you some interesting charts where I'm able to generate a fiscal surplus, declining debt to GDP. Those are all simulation, but it's an academic exercise. So now let's get back to the real economy, and we start to see some forecasts. Okay, why we need macroeconomic variables forecast? We need it in order to assess where the economy is in the real business cycle. At which point the economy is in the real business cycle. If we have an expanding GDP, if we have too hot inflation, if we have seen in the past 2 months a negative GDP, so probably the economy is going into a flat or a negative output gap. So, but the economy, it has been running at potential, or it has been running below potential? I mean, zero output gap is because the economy is running at potential, or because it's running at zero. So there are many things which are which are beautiful to understand in terms of macroeconomics: aggregate supply, aggregate demand, the level of unemployment, the level of inflation, etc., etc., etc. So the forecast that somebody tries to do of macroeconomic variables, of course, is an out of sample forecast. Okay, you see here the software forecast for the rate of inflation. You see here this red dots line that is technically defined as out of sample forecast. Okay, so everybody knows that you cannot have a forecast of 45 years down the line what's going to happen, of course. So the forecast, the out of sample, technically the out of sample forecast, it can be implemented for a few months ahead, a few quarters ahead, maximum 8 quarters ahead. That's what I've empirically experimented with the softwares. But a 45 years forecast like the UK economy will be at 270% debt to GDP, that is totally nonsense. And I'm surprised that people, the OBR, puts out some kind of thing that it's a typical differential equation of an exponential growth model. It's just it's basically it's y, the variable, the unknown y of t. So the differential equation it has a t parameter, which is time, equals 100x, which is 100% debt to GDP, times e exponential to the power of minus 0.0248 t. Okay, so it's an exponential raised to the power of 2.5% for the time t. Okay, so if you take an exponential raised to the power of 0.025 times 45 years t, you will have basically 100x going to 270. So it's simple mathematics and nothing to do with out of sample forecast. And so, okay, so back to us. What I can see in the forecast software, that models that I put through, I can see that inflation would eventually be going up in the next quarters. Okay, where is the table? Oh, okay, so yeah, we have an inflation. Okay, the CPI rate probably it could be slightly declining to 2.6%, but there is also an upper bound level of 3.9%. So you see here the the red shaded area is a very wide confidence interval, so 4 quarters forecast, it has a lot of uncertainty already. I don't see how you can provide a 45 years forecast. It's totally nonsense. So the overall most known CPI inflation rate will be around 2.9, 2.6%. So you would think, okay, maybe the rate of inflation would tend to converge towards the price stability target. Maybe I can have a rough idea that I can cut interest rate a little bit if inflation starts to go down a little bit. So another measure here of inflation, the retail price index, including housing, that's quarter on quarter. So there will be steady between 0.7, 0.8 quarter on quarter, which basically it's more than 3% per year. Then here we have the CPIH annual rates for item. It's changed at the 2015 price base here. And we can see here that CPIH will be eventually, in my auto sample forecast, will be slightly going up, increasing. So there will be a rising CPIH in the coming quarters. And I have here a 4.5%, 4.4%, to then go to 4.2% in 2026. But basically what the CPIH tells me is that between 2025 and 2026, the rate of inflation for this measure, which includes also the housing cost, it will be around 4%, or a little bit, or also a bit more than 4.5%, 4.6%. So that's not a good data point for the Bank of England, for example, to say, okay, I can easily cut interest rate. Okay, but also just to be more precise, you see here residual distribution. Okay, so the residuals, they have a bit too much long of a tail, so probably there is some white noise or error noise in the expected parameter that you have. Those are nuances for the people who read the data. I can tell you here, for example, when we see here kurtosis, let me widen up a little bit the reading of the thing. So the kurtosis, it helps us to understand, I repeat it always over and over and again, the skewness and the kurtosis are the third and the fourth moment of the expected theta value that we want to estimate from our distribution of data, our IID random variables. And so when we have a kurtosis parameter that is larger than 3, we can expect that the data in itself has a fat tail distribution. So what it means is that, for example, there are these dots which are very far away. So we have large outliers values. In what sense? The outlier value is this inflation data which goes very far away from 2%, it's 10, 12%. Okay, those are when basically the software goes through all the data points, it sees that you don't have a trend that is always symmetrical to 2%, but you have this huge mountain jump up to 10% and then going down. So you have a larger kurtosis. So the expected third moment expected theta that you are estimated as a kurtosis which is larger than 3. So there are fat tails values. It means also here we have this bell curve. When you have these long tails in the distribution, it means that there are fat tails. There are outlier values which are very out of the range. Okay, so that's important to understand when you either for financial assets, when it's returns of stock prices, or in this case when it's inflation. You would expect that inflation it doesn't move a lot, but instead now everybody has learned that inflation is very volatile. And here I want to help you understand another thing. We see an autocorrelation function. You see here that we have this blue shaded area, but we have a sort of downward slope. So there is a moving average, a sort of average. So when we have this 1, 2, 3, those 5 or 6 bars which are outside the blue shaded area, those bars tell me that the CPIH, excluding overruns of pairs, etc., it has a 5 lag autoregressive correlation. So it's autocorrelated up to 5 lag before. Okay, so when basically the software does a first reduction of the autocorrelation, you see the partial autocorrelation, there is 1 and 2 bars which are outside, 3 bars, you have a lot of bars which are outside. So it means that there is also a sort of moving average, and then it means that basically the whole series of data which are collected by the ONS, they are not always the same, they vary a lot, and they are correlated with the past data. So if I have inflation in 2024, I will have some sort of inflation consistent in 2025 because they are correlated one period to another with a lag. Okay, so that's the beauty of understanding this thing. So here another measure of inflation, and we are 3% slowing down to 2.6% in 2026. So there is also a bit of overfitting, so a lot of the same thing, a lot of inflation measures that I have fed through the software to understand the various levels of inflation. And here, for example, the marvelous RPI, that will be around 3 point, always more than 3%, 3.1, 3.3, 3.2%. You see that RPI, it's a lot, or it has, shows 1, 2, 3, 4, 5, 6, even 7 lags of autocorrelation function, so it needs it needs some sort of 5, 6, or 7 AR, and then you have at least 2 moving average to find out what is the basically non-volatile series of data. Okay, so personal expenditure, we have somewhat of consistent level here, going from 5%, slowing down to 4%. Yes, 4.9, leveling down, leveling around 4.3%, and also it shows autocorrelation and partial autocorrelation. So this RPI level at 8% is huge. No, it's 8%. So let's jump in that. No, not all the forecasts they are perfect. You see here this measure of inflation. I don't have a very good concatenation, so I see the data and I make an idea of. That's also here. CPI excluding food and alcohol and tobacco, that's a particular form of inflation measure, and it jumps from 0.2 to 0.8 per quarter. It's very jumps a lot around, so it's not really consistent. Okay, that's another measure. Okay, so the CPI excluding food, alcohol and tobacco, it's around, will be around 1%, 1.2% per quarter. We see here all the autocorrelation charts, they show a lot of autocorrelation. And okay, no, that's okay. Energy, tobacco. Let's see the that's the here there is not a lot of autocorrelation, but what I was seeing now, here it's when the software analyzes the unemployment rate, there's a lot of autocorrelation with the past periods, and the software tells me, okay, you will have a rising trend in unemployment. So that's another data point I will have. Very surprisingly, the other sample forecast tells me, oh, okay, there can be the awkward situation where we have when you find rising inflation and rising unemployment, that sort of stagnation. Okay, so we're building our macroeconomic framework. So we can consider that the inflation rate for the UK economy will be around 3-4%. If it's very persistent or very sticky, it will be some measure of inflation like those including housing costs will be above 4%. That will be eventually a problem for monetary policy and also for fiscal policy. The other issue or the other problem is that the auto sample forecast, without taking account anything, just the software, the ARIMA forecast or the seasonal ARIMA forecast I will show you in a bit, it takes the past data of the blue line are all the past quarters of unemployment, and then it projects the red line and the shaded area with an auto sample forecast. So there are no other variables. You just take those data and it projects it out. And it shows me a rising trend of unemployment in the coming quarter, which is not very encouraging. Okay, so yeah, it shows me unemployment 4.7%. I think we are already there, and so it's consistent with the actual levels of unemployment. At the same time, the software goes through the employment levels, and it shows me that we are around the same levels, around 75%, 75.2%, 75.4%. But we had a peak. The UK economy had a peak before 2020 of around 76.4%, and now it has been averaging around the 75 mark. It's been floating around the 75, sometimes going 74 point something, 74.2, sometimes 75.2. We are around there. We see here in 2024, at the end of 2024, we have a bottom of 74.5% in employment rate, and then it's gone up again. But we saw that on the other level of the labor market, we have also a rising trend in unemployment, which is not very comforting, and it tells us that basically somehow the engine, the inputs, the engine, it's faltering. So the aggregate supply in the economy, it's faltering a little bit, it's slowing down, and at the same time there is a stickiness of prices. So that's the main feature of the UK economy, of most advanced economies. When you have those periods in economic history, let's say like that, or you have some sort of dynamic equilibrium in the economy, which describes some higher levels of input costs, and at some point the engine it's overheating, and then all businesses, they start to shrink the rev, all the the rev. What I'm saying, the revolution of the engine, they start to go down because you want to cool down this overheating economic engine, which is not able to push any more higher than that, and it costs a lot to keep it going, like the engine of a car. Okay, so we have a car which is overheating because you have higher costs, higher input costs, you have sticky inflation, and the engine, it's running at higher revs, it's going fast, but the speed is not increasing or is not improving, so you don't have economic growth. Okay, so for the same level of speed, you want to rev down, to scale down the thousands of revolution that the engine, the piston does in the cylinder. So when you scale down the power, the horsepower of the engine, you reduce the input in the economy. So it means that you start to cut, you start to reduce the workforce, or you try some ways of optimizing goods that you utilize. But basically, what we see here is that for as much as the Aston Martin engine of the British economy wants to go, we have it a speed limit. So businesses, they are reducing the horsepower, and they are reducing the workforce. So that's the overall metaphor that I can provide. Even if I'm stumbling a lot, it's just to take a pause while I'm speaking. But anyway, here, for example, we see producer price index for manufacturing products is more or less flat around 0%, nothing very special. The same is the output costs. It seems flat around 0%, is normalized after the 2022 shock. But nevertheless, because these are percentage changes, you need to be aware that the 2022 inflationary shock has basically changed the base price level. Okay, so even if we see that the blue line goes down, those basically what tells us is that, okay, the price of input has gone from 500 to 1,000, but then it stays at 1,000. It doesn't go down from there. So the economy now is working in a with very expensive input cost. So what business are doing in their trade-off choice is to reduce the workforce, especially because it has been made more expensive to pay for employing additional workforce. So they are not hiring, and they are reducing the input of labor. Okay, that's what happens vis-a-vis unchanged input costs, which have increased a lot with 2022 disaster, and they are staying at those levels of cost. Some costs have decreased, but now we have tariffs, for example, again. So those output costs in exporting manufactured products, it will go up. And those are other variables that down the line will fit through the engine of the economy. That's why, let's say that the economy is a dynamic model. Let's take it as an engine. There are the cylinder, there are the pistons, and there are the inputs, which are the gasoline, fuel, petrol, the oxygen, and then the pilot. So there is the workforce input and some stuff like that. So, okay, import costs, including crude. Okay, the auto sample forecast, it's more or less 0.2% quarter on quarter. Okay, so we can start to build an idea of the what the auto sample forecast they can tell us for the next 4 quarters. For example, here we see GDP to be around 0 point something quarter on quarter. Yeah, the past quarter was 0.7, 0.7 again, 0.6, 0.7. So less than 1% per quarter is very optimistic. I can tell you right now that this auto sample forecast is not very convincing, because the Q2 data will be flat or negative, and we will see in a bit why. Retail sales chain volume, okay, 0.6 or 1.2%, that's more plausible. Okay, retail sales including petrol, upwards. Trend in retail sales between 2 and 3% going into Q2 April 2026. So basically, the auto sample forecast tells me, okay, we have a stable consumer base. There could be higher unemployment coming in, somewhat of higher inflation, stable GDP growth more or less, although we are going towards probably flat output gap, balance of payment net, NSA quarter on quarter. So balance of payment usually is always negative, so imports are more than exports. Here is in proportion of current account of GDP. Yeah, it's 2.7%. The balance of payment deficit, which is projected to be more or less at the same level. Secondary income, okay. Okay, so for the same model, I've implemented again the same model with the seasonality effect. So I have more or less the same data. Rather than CPI is projected to go to 3.1% and then be at 2.8% 2026. RPI housing is projected to go up again quarter on quarter. The CPIH confirms to be above 4%, 4.5% for the rest of 2025 and 2026. Okay, those are all the other inflation measures. We see a bump up also with the seasonal effect. We see here that's the AR, 1 AR, 3 moving average, and you have 4 seasonality effect. So we account also for seasonality in that kind of iteration of the autoregressive integrated moving average model, which is a seasonal autoregressive. Okay, we have lost connection. Let's hope to take connection again. Okay, so we see that with seasonality, the CPIH excluding the housing cost will be around 3% for 2025 and be around 2.7% 2026. So those are consistent level of inflation for which monetary policy, it won't easily be in the position to say, okay, we will go from 4.5 to 2%. That's very, very difficult. So even if the Bank of England managed to bring home something like a quarter percent of cut or 0.5% of cut, that would be very good for the overall economic engine of the UK. Okay, RPI all items, we are around 3.5, 3.2%. Okay, change over month. Yes, so that's the most known rate of RPI because it's measured every 12 months and we are still 4.9, 4.4%. So that's not very good. That's RPI of that. So the retail price index of rent. So housing costs seems to be steady around 8%. Very, very, very difficult. So let's go quickly to, I want to see the Bank of England. Okay, here with seasonality effect, we have again the same trend in unemployment. Consistent with the data we have now, 4.6, 4.7%, rising a little bit, same level of employment, around 75%, 75.2%. And the level of employment then, it's important, and the hours worked are important for understanding what are the level of total factor productivity vis-a-vis what are the investments that come into the economy. And we will see in a while what I'm talking about. Okay, GDP, real GDP around 0.4, 0.5 per quarter, hopefully, which will be around trend more or less. I want to see the BOE forecast. I mean, I've seen the forecast a dozen times during these days. I hope you are enjoying summer. It's very hot summer. It must be beautiful at sea, and seaside and the beaches and stuff like that. Okay, Bank of England bank rate, the forecast very automatic forecast around 4. It stays where it is now. 4.25%, 4%. Hopefully, the lower confidence it's 3.5%, but it's that's quite difficult to forecast like that. I think that they can do 1 rate cut or 2 rate cuts. They can do it. They can try to take some sort of risk with that. Households' final consumption, same level, 0.4, 0.5, 0.6% per quarter, which is in line with real GDP growth. So we see that some data they correlate together. For the level of activity, so GDP growth around 0.4 or 0.6, 0.7, more or less. When you go and check what is the household's final consumption quarter on quarter, it's more or less the same rounded percentage level. Here another ARIMA model is more fancy with more data, and you see here exactly the trend, recent data, and it narrows. Here it narrows the window, so it's more visible the 4th quarter and up to 2028 forecast. So we see here, for example, the inflation will go up in 2026 and then it will go down again, but it won't be easy to have inflation converging to 2%. And that's consistent with the concept that I gave you before. So we don't have the so hoped technological improvement that gives us a fast organic growth, fast expanding aggregate output, aggregate supply output, so that we can see a decrease in inflation because we are producing more things. So the AI component, it doesn't help us producing more stuff because AI is digital. Okay, it can help me. I have Gemini. It can help me to double check if I do some code error, but Gemini, it's it's a nightmare. I can't use it because the Gemini code, it makes error the AI, so it's unusable. Okay, so you see here how artificial intelligence, it doesn't help by now the economy in producing more things, more goods, more services, maybe more services, a bit more digital services, or it can improve efficiency in digital services, but we are not producing more. So the aggregate supply is not, it has not been expanding. And so that's why you have a, a consistent risk, let's call it risk, of the fact that inflation, it won't easily converge to 2% for the UK economy. But we see here, for example, that the ECB is forecasting an undershoot of inflation. It depends. I mean, or the US economy is trying to push inflation towards 2%, but I see that difficult. So, here. Okay, so CPIH will be converging towards 2% around 2027. So these are more or less reasonable expectation of some sorts for how precise and accurate can be the output of the model. The residual, they seem to me quite, there is no white noise. The ACF and the autocorrelation charts, they are not showing anything of anomaly. So it means that once the data has been made stationary without so much error in the expected value, in the residual or the expected value, so what the software tells me, okay, the CPIH inflation rate will be converging towards 2% around 2027, which is very far away. So again, artificial intelligence is not helping the economy in lowering inflation. It does help us in producing more things. So what we got left, what is the other known mechanism for inflation to go down is when the asset bubble deflates. So you have a very slow economy or a recession in that case. So let's jump on the third autoregressive model, and we start to see some other things. Okay, so I have a fourth autoregressive model with regime switch. So that's basically, without going into the details of the thing, when we see CPI, okay, inflation again, the red area is when you have a switch in regime. So when basically inflation has jumped to north of 10% from what was the ordinary trend around 2-4%, more or less, then you have a jump, and then it's what is called Markov switching model. It identifies in the trend, in the data, when there has been a change, a very large change in the data, and it defines it as a regime change, or basically it's a state of the world change for the inflation measure or the parameters that you have. Of course, it measures what is the constant coefficient and the volatility coefficient, and what are the statistically significant probabilities that you can have another change in the state of the world from a normal trend to some very large percentage change or deviation from the average trend. So that's what basically it's useful for this Markov's switching model, and also provides the auto-sample forecast. So state space model, so it models out what state of the world will be that time series, and we have again CPIH will be around 4%, so that's consistent, and it will still be in the red shaded area, so it will be in this very high inflation state of the world, rather than converging to the average trend, historical average trend. So I can measure that for each and every variable that I work through, and I can see where I can have persistent inflation when, for example, I have higher unemployment. RPI, basically retail price index, has gone full tonto since 2009, probably 2010. It has totally switched state of the world. A totally switched model. So the Markov chain model tells me, okay, RPI, it will be in a high persistent inflation level, around more than 4%, more than 10%, and by no time soon will change to a more moderate level. You see here, projecting very high RPI, that's for rent. So, okay, it's very interesting. We see here the forecast, auto-sample forecast RPI percentage change over 12 months of rent prices. So it projects out a trend going north of 8%. And it tells me, okay, don't hope in a switching model of the rent inflation regime, because will still be a very high cost, a very elevated retail price index that measures rent costs in the economy in aggregate. Okay, so those are very, very interesting, but if we have to go all one by one, I will spare this thing. I want to take, okay, so then I started to implement the first hints of short-run aggregate supply models, and I start to have gathering some idea, some data points around what is the Philip curve, what is the correlation between inflation and unemployment, inflation and input cost growth. We can see that both the Phillips curve and cost push inflation, they are both positively correlated. So when one goes up, the other one goes up. So it's those are all about economic theory, macroeconomic theory. And okay, let's go for something which accounts for the 2025. This model stopped at, because of the lags, basically it stopped at 2022. It doesn't account for all the most recent data, so unfortunately I'll have to jump on that. Okay, so we start to have an idea, UK macroeconomic dashboard. Okay, so we see here what is the most recent inflation trend, GDP growth, which is around 0.7% or 0.5%, the employment rate, and here we start to see labor productivity. We see that labor productivity has been slightly negative vis-a-vis the hours worked, hourly hours worked, and the net investment going into the economy, and the input prices. So there is a sluggish productivity in the economy. So then the model, what does, it extrapolates the one of the many times that the software has extrapolated the short-run aggregate supply model, which is, okay, actual versus predicted, but basically this reflects more the inflation rate. And basically what it does, it interpolates the output gap with the inflation. And it tells me, okay, positive output gap reduces inflation by that small coefficient, which is 0.10%. So, which is very counterintuitive, because when the economy is expanding, reasonably you would expect a bit high inflation. But on the same level, we see here that the model tells us inflation shows strong persistence. So an important factor to consider is that the inflation component for the UK economy is very persistent. I don't know how to define inflation in the engine metaphor. Let's say that the engine consumes a lot of lubricant, a lot of oil, so it has a very sticky it has a very sticky way of operating, of revving up the motor. Okay, so it requires some very expensive gasoline, some very expensive input, and it's very sticky, so it requires also it burns a lot of lubricant, more than what would do an efficient motor, an efficient engine. So we need to have a word with the Aston Martin and McLaren and Red Bull and engineers, power unit engineers, and see why this power unit is consuming too much lubricant. I'm just joking, but just to give you an idea. So that basically the persistence of inflation, it's probably that the economy requires for too long time requires too much stickiness in the level of prices and in the level of input costs. There will be rents, so the cost of having some premises, of building commercial premises for having an office or a factory, and also the input costs. There will be goods or energy costs, and at some point it will be also the input of the workforce. So those costs seem to be sticky, seem to be high, and that translates automatically in the final output that goes into the economy. So that's why, I don't know, you have doctors which they want 25 pounds per hour, because life is very expensive. The cost of living is very expensive. So the whole engine of the UK economy, this large Rolls-Royce engine, it requires a lot of lubricant. It's very, very sticky. The movement of the pistons into the cylinders and the whole power units requires a lot of lubricant, and there should be some financial, economic, fiscal policy, monetary policy engineering in order to make the economic engine more efficient, in order to make it work with lower inflation, less sticky inflation, optimize the use of lubricant in the engine so that you have more horsepower, you can speed up the rate of growth with less consumption of costly inputs, which is gasoline and lubricant and so forth and so on. So other than that, then I started I put together some GDP measures and to see basically the quarter-on-quarter potential GDP growth using an HP filter, which is an Aldrich-Prescott filter, and all people who do postgraduate and even PhD study in economics, they all read Prescott books about the real business economic cycle and stuff like that. So we see that basically the data tells me that real GDP for the potential quarter-on-quarter growth has been around 0.4, 0.5% trend in the past 30 plus odd years. And we are basically, the quarter-on-quarter growth, it's always around trend. We are not deviating much from that average, but we start to have another, I learned another things. So that you can see that also in my short update, because this video will be very, very long, now you'll understand why I have to do short updates. So best correlation occurs when inflation leads by 1 quarter and we have a negative coefficient. What that means basically, if counterintuitively, but that is a feature of the UK engine, is that basically when I start to see, at some moment in time, when I start to see inflation going up, and at the same time I have GDP quarter on quarter which is around potential, what that means is that, okay, GDP brings up inflation, but I need to know where, at which point the business cycle finds itself, the economy, the whole aggregate of the economy. And what the chart here tells us is that basically inflation leads by 1 quarter, and it can foresee, with hindsight foresee, I don't know if the two go together, but basically when inflation goes up, it leads the outcome that you have a negative output of minus 0.12%, negative output gap. So that means that real GDP grows less than potential, okay? Or in this instance, you have the blue line, which is below the green line. So that means that real GDP is trending below the potential quarter-on-quarter growth. And so I learned another thing, which is important to understand. So the fact that I have persistent high inflation in the UK economy, it tends to have also a negative effect on the output gap. So it's very, very vital for the exchequer and all the people of the treasury, all the people who work for in economic policy, monetary policy, to quash inflation. So to go to the root causes of inflation in the economy, which could be house prices, rent prices, input costs, or energy costs, the many things, and try to set some decisions in place in order to control inflation and to have a positive output gap. That would be vital for the overall economy, because that brings more employment naturally. Okay, so again the same here. We in reverse, what says here, the output gap leads by 7 quarter the inflation. So our output, okay, GDP UK world economy output per hour worker worked changed per annum, seasonally adjusted. Okay, so what that means is basically here the output gap has been measured with the hours worked. So if we have naturally, if we have more hours worked into the economy as a form of economic growth, measuring GDP or the output, we see that even with the 1 year, 1 year and a half, 2 year distance, it leads to basically positive inflation by very small coefficient, 0.06. It's very, very small. It's negligible. But nevertheless, we learn that when there are more hours worked, it tends to be a positive correlation with the inflation into the economy for some good reasons. Because people work more hours, probably they earn more, so they spend more. Okay. Now we have another important chart that I showed you already. So that basically monetary policy is in a bit of a pickle, because they should have eventually hiked interest rate a lot more during 2022 and after 2022, even north of 10%, because food inflation or inflation overall in the UK was more than 10% year on year. So the Bank of England had to stop at 4.5%, because they cannot go for the quantity, the amount of debt that there is in the economy. It's very difficult for the Bank of England to hike interest rate to a level which is restrictive enough to quash any inflationary shock. Okay, now in macroeconomic terms, or also in a dynamic economic model, for what concerns, in particular for an energy shock, a policymaker can can see the energy shock as a transitory shock. So you see that energy prices go up one-off or for a few months. For a lot, you have a huge standard deviation in energy prices. You have an inflationary shock from energy, but then it converges to some average level. So let's say that energy shock, because they are very volatile, they are not inflationary shock, which are, for example, when you have a sustained higher level in services prices. So that's what the case of the UK, because the inflation basket measure, which measures the services prices, it has been for more than 1 year, 2 years, at 4%, at 5%. So there is also that component. So we learned by a very extensive number of words that there is a persistency of inflation component for the economy in Britain. And that has never been resolved with some notable improvement in productivity or some very restrictive fiscal and monetary policy that could cause a very prolonged economic recession. Of course, policymakers, they will not take the Paul Volcker moment and say, okay, now I'm going to screw everything and send the economy into recession, because it's not the simple economic recession, is that you have to basically make pop the bubble, the asset bubble. So you'll have to see basically a sharp, short shock in the real estate market, so a consistent decline in asset prices, financial asset prices or real estate prices, in order to restart the economy from much lower costs. And then you have organic inflation and work your way from there. But policymakers, they don't want to do that. They just keep the same level of inflation, which accumulates for a long time until basically the whole system tips out of balance, and basically they find themselves under an avalanche, the snowball effect of asset prices that are tumbling down. But at least they can say, oh no, we didn't want to cause the recession, it's because it's speculation. Okay. But nevertheless, we see here that the Taylor rule, for example, shows us that for the long decade of quantitative easing, potentially the Bank of England had an ultra-low interest rate monetary policy, which was not very useful in order to price appropriately, price with more consistency the cost of the money supply. And that would have probably very much created, would have very much posed a constraint in the ability of the government for the past 10, 14 years to have so large fiscal deficit every year, because they were borrowing at zero. So it's free for all party. But if the Bank of England would have set the bank rate at 2% instead of staying at zero for 10 years, then you are pricing the money supply, and the government, it has to do some 2 plus 2, some calculus, some simple arithmetic, and say, oh, I'm not borrowing at zero, I'm borrowing at 2%. So it's another kettle of fish. So what has contributed to the past couple of years, 3 or 4 years inflationary shock, it's somewhat very lax, very, easy, very too easy monetary policy everywhere in the world. And we want to see Japan or the United States or the ECB, I mean the Bank of England, they know what they're doing. I'm the last person in the world. It's a wider problem in the global economy that there have been for too long too low interest rate, and now we find ourselves in an asset bubble. And even if we have Gemini that can write for us a code, we are not producing more stuff. So sooner or later, the asset bubble will have to pop. Even if we have 2022 inflation at 12%, and you stop at 4.5%, while the Taylor rule tells you probably you should have hiked north than 10%, you want to do that. You want to see through the inflation shock and, fingers crossed, hope that inflation converges to 2%. But now, later, inflation has been rising up again. So again, there is this constant dim, the feature of the UK economy, that you have persistent rate of inflation. And on average, CPI in the past 35 years, it has been around 3.3%. So there has never been an average rate of 2% inflation in the UK economy. It has always been an overeating economy around 3%, 3.5%. And so monetary policy struggles to find the optimal level of interest rate. And so what happens is that we have this sort of mismatch between the level of what should be the more appropriate level of interest rate, and we find ourselves that the output gap is slowly deviating towards negative output, and inflation tends to be persistent at higher levels. So it's a problem for monetary policy, because basically if you have high inflation, you tend to be steady on the same level of interest rate. You don't want to cut interest rate because you want to control inflation expectation. But at the same time, you see that the output gap becomes negative. So the economy starts to slow. You have unemployment. So on the other side of the balance, you need to eventually reduce interest rate in order to make possible that the economy absorbs the slack that it comes up in the labor market, and so the output gap starts to converge towards trend. Okay, but you cannot do that because you have two opposing forces. You have high inflation and you have negative output. So what to do? You keep up interest rate or you cut interest rate because you have negative output and you have higher unemployment. So that's the big question that policymakers find themselves in. So that's why the monetary policy needs the help of fiscal policy in order to set the level of interest rate with other variables in the economy that start to work toward the right direction, the proper direction. Okay, here we have another interpolation between inflation and output gap, and we see here, okay, using CPI and real GDP growth, we see that inflation leads by 1 quarter in advance with a negative coefficient in the output gap. So we have this slight problem of the inflation output gap correlation, although it's minimal, but persistent, constant inflation for the UK economy is not good. It's like having for a long time high cholesterol, then it's not good, okay? Because it leads to, it brings then the economy into a negative output. So you have slowing GDP growth, basically. So here the same, okay, trying to see estimates, basically the GDP trend quarter on quarter with the Kalman filter instead of the Prescott filter, the outcome is more or less the same. But we are around flat for the output gap, and we have to hope that the economy will not be slowing down too much. But I have the sense that businesses, they are not hiring, they are laying off people, and so automatically the short-run aggregate supply curve, basically it moves basically backward towards a lower level of output, and that means that you have a lower aggregate level of GDP. So let's see what we can find more to understand the overall macroeconomic picture. Okay, I have so many models that I haven't studied it all, but okay. So here we have a standard or standalone estimation of the output gap with multiple GDP metrics. So we have Kalman filter, the HP filter, and basically we see here that the composite output gap is of 0.03%. So it's very, very, very tiny. Okay, we are around flat in the output gap. But that at the same time, it does, okay, here we see trend growth around 0, current gap 0.7%. Okay, so these are the different measures. So implied deflator, trend growth is here, current gap, it's negative. Okay, if we imply the GDP deflator, already start to see the current, the ongoing output gap, it's negative 0.5%. Okay, and if we measure the GVA, the gross value added, we have a negative output gap of minus 0.15. So the overall composite is around flat, 0. So again, the question then becomes, the question is, are we growing at potential? So the economy is going at 200 miles per hour, or we are going at 20 miles per hour, and we are basically slowing down, flatlining, and with the risk of basically stagnating or of basically going to 10 miles per hour or to 0. So that's the importance of measuring the output gap. In my view, basically the economy, the UK economy, is not growing very fast, and so it's a slowing economy. So I measure the output gap for all the other time series, and I have the gaps. I'm minding the gap of about everything. Okay, so here, for example, we start to inform ourselves again around the OLS regression. We want to see what is the Phillips curve behavior. Okay, so we know that basically we have just seen that with implied GDP deflator, technically the output gap is negative half a percentage point, 0.5%. Okay, so what happens with the Phillips curve? How inflation and unemployment rate interact with each other? Okay, so we see here, okay, the p-value of the unemployment rate is significant at 10%, but nevertheless we can use it. Okay, CPIH with lag 1, it's very consistent in a statistical standpoint, and we see that they are positively correlated. So there is a very gentle upward slope. So it means that tendentially higher unemployment can live together with higher inflation. That's what it's happening now in the UK economy. You have rising unemployment, 4.6, 4.7%, and you have also high inflation. Okay, so what comes out in the chart here, it's very consistent with the real world. So that counterintuitively, when you have higher unemployment, you should have lower inflation. But instead, in this instance, you have both things that go up together, inflation and unemployment, which is not an ordinary thing. Okay, so if we measure the total factor productivity growth with the solo Cobb-Douglas function, we see that total factor productivity is slightly negative, minus 0.1%. So also productivity, it struggles to be a consistent factor for the economy to push forward. Okay, so now we start to see short-run aggregate supply curve. So we have what happens with the inflation surprise and upward gap. So we are here at 0, the point of balance, where there is the most of the dots, and we see that there is a positive slope here, but we have also a large negative slope. So it's consistent with the fact that higher inflation can also lead to a negative output gap, or vice versa. Lower inflation leads to a negative output gap in this instance, because it's a linear regression. Phillips curve, it's more or less the same, and okay, labor productivity growth, it's the same. These are all OLS regression, somewhat more or less significant from a statistical standpoint. Okay, so let's see what else I can give you. Okay, so okay, then to have a complete study to see what is the interaction between the macroeconomic variables, I had to run also some VAR models, also the VECM models, to see what is the co-integration of these factors. Here, if we take here, okay, I need to show you here. Okay, so okay, we have an optimal lag choice for the model according to the AIC criteria. We have 3 lags for a certain bunch of variables. For example, we see here that unemployment, it's correlated. So the dependent variable, which is unemployment, it depends from which other variable? It depends from GDP growth, okay, or it depends from the Bank of England with a lag. So if the Bank of England moves by 1 unit its monetary policy measure, we see that, for example, we have a negative 0.11.5%, 12% in unemployment. So we have a negative lag effect on unemployment. The same is for GDP. If GDP declines or moves up, for example, we have a decrease in unemployment. So that's the usefulness of the multivariate econometric models, which are the VAR models or the VCM models. You can see which are the variables that interact with each other and have an idea. I also have a forecast, which is still the same: higher inflation, higher unemployment, a flat GDP, Bank of England, which will try to cut interest rate. It's more or less the same framework that we have seen in 2024. It's replicated in 2025. On a wider scale, basically, the Bank of England would like, also policymakers, so the government would like the Bank of England to cut interest rate, but it's very, very difficult because inflation is sticky. And inflation is sticky also because, for example, the government has found the immediate necessity of increasing the cost of national insurance or some other taxes which are reducing the output in the economy. So I think that to solve this conundrum, there are some other bold, very structural measures like like changing totally, for example, the PAYE income tax structure. So I'm profoundly sure and convinced that the UK needs a more progressive income tax structure. So they will need to set some more income bands. They would unfreeze or just turn off the fiscal drag, so they will have to adjust the income tax rate with the yearly wage growth. So, there are a lot of things that they should do to change, to improve the economy. So here we have a plethora of VAR iteration that I'm sorry I will have to jump on because I want to stick with charts which are more which are easier to understand and immediate to understand. So I was talking about the necessary things to do. For what is my humble understanding is that basically the tax structure needs to be more progressive, more income brackets, so changing the pay-wage structure, doing special economic zones, giving some tax rebate for employers, stuff that would basically free up capital in the economy. Okay, it's a pity that we cannot go through the VAR models because those are very, very interesting, but we cannot stay here until tomorrow. Okay, so I will show you here what I'm saying again. So here we have a potential GDP level in the long run on a logarithm scale, and the pink line is the logarithm scale of the UK GDP. We see that they are basically sticking, but the pink line is a bit below the potential. So it's basically growth is flat, output gap is becoming negative. Okay, so we have also on a logarithm measure this fact. And if, for example, we try to estimate what is the natural rate of unemployment, or NAIRU, what is non-accelerating inflation rate of unemployment. So that means it's the level of employment or unemployment that doesn't push up inflation. So we see, okay, the pink line it's the actually unemployment rate in the UK now, which is around 4.6, 4.7%. The trend line, the NAIRU estimate, it's below. It's, let's say, around 4.2, 4.4. Okay, so what's happening in the economy is that a slack in the labor market, it's opening up. Well, it's another gap that it's opening, and it's the slack in the labor market. So people are being laid off. So unemployment is going up. If you have a slack in the labor market, and so that's why you have negative output. So I'm repeating again, and by modeling different things with different econometric measures, you can have separate data points that are consistent with the same concept. Higher unemployment, higher inflation, slow economic growth. And so some very important decisions have to be taken. Now we see here, for example, interpolating GDP growth with the aggregate demand model, not the aggregate supply, and we are pretty much flat around 0 point something. But that it's the quarter on quarter. Of course, the economy cannot grow by 1, 2, 3, or 5% every quarter. Okay, so okay, here it's a very nice chart, basic macroeconomics, like potential output, and you have the balance point between the aggregate demand curve, the short-run aggregate supply, and the green dot is the equilibrium point. So at equilibrium, you ideally would like to have 2% inflation, 4% interest rate, maybe even 3.5%, and zero output gap. In which sense you want zero output gap? You want the economy to run at full potential, okay? That's what is not happening, because we see that the real data is turning negative. GDP growth, economic growth, it's slowing down. Now, what I actually managed to do also with the help of Gemini is to produce a scenario and say, okay, if, for example, the Bank of England will start to cut interest rate, what's going to happen to the aggregate demand, the aggregate supply, the output gap, the inflation, etc., etc., etc. And we have some parameters. So, latest data observed, we see that Bank of England is around 4.33%, 4.5%. It tells me that the economic growth is slowing down, potentially is negative, and the CPI inflation it's around 3.6%. So, vis-a-vis the short-run aggregate supply model and the aggregate demand model coefficients, if the Bank of England would theoretically reduce interest rate by 0.5 percentage points, let's say they make two interest rate reductions, 0.25 and 0.25, how the other macroeconomic variables would evolve or react? What would be the impulse response function of those macroeconomic variables? And the simulated part tells me that inflation paradoxically would go down. You still would have a marginally negative output gap. Here brings me a policy of 4.3%, but in 20 periods forward, we see that the path of inflation theoretically would converge around 2.5%. Output gap from negative output gap will go back up towards a neutral output gap of the long run aggregate supply of output gap. So it will balance out. There will be positive economic growth, in other words. Okay. Okay, here we have another chart that tells us what is the dynamic response if eventually the Bank of England will cut interest rate. We see the CPI theoretically, hopefully, would converge from 3.6 to 3% in many periods forward. Okay, output gap, maybe it will be slowing down, but we are starting from a negative output gap. That's a simulation of the path forward. And we expect the policy rates to go to 4% or to 3.75%. And we have the end table. Okay, so policy rate at 4%. So we go from 4.5 to 4%. I think Bank of England is 4.25. Let's say they make one cut into the bank rate. Hopefully, expected inflation path, the inflation will continue to go down. You have to expect some inflation deviation or some volatility, and the output gap deviation. So you can have a shrinking output gap, or otherwise you can have also an improving economic output or economic outlook, so that the economy grows because you are reducing the cost of borrowing. But counterintuitively, maybe even inflation will decrease a little bit if the Bank of England decides to modestly reduce the interest, make one interest rate cut, 0.25 or 0.5 percentage point, I don't know. So that's very interesting for me to see what theoretically is the theoretical scenario, shenanigans, theoretical scenario of that sort. So if the Bank of England will reduce interest rate, it would be good for the economy, and hopefully it won't be so bad for inflation. So maybe inflation also will tend to decrease, because eventually the borrowing costs, they are a component, they are otherwise a component also of inflation, mortgage costs or business corporate borrowing costs, so forth and so on. So I think that's all from me. So let's go back to the theoretical scenario. So we are encouraging the Bank of England. We are being very nonsensical, but from our scenario, we see that we have a consistent, we have a negative output gap. We have higher inflation, but we have a slack into the labor market. From our dynamic model response, we see that in 20 periods forward, if the Bank of England will reduce here interest rate by 1 percentage point, let's say they cut by 0.5 percentage point, yeah, simulating 20 periods, that's a policy rate shock. So they reduce interest rate by 0.5%. We have here inflation initial state of 3.6%. It has a negative output gap. We see that inflation tendentially could converge towards 3%, at least the headline rate, CPI rate of inflation. And we'll have some response also in the short-run aggregate supply and aggregate demand curve. But nevertheless, we could hope that GDP would basically not be negative, would start to grow a little bit. So by the end of the video, I would encourage Bank of England to at least make 0.25 or 0.5% reduction in the bank rate, because the economy is slowing down, unemployment is going up. So it's been an immense pleasure to be with you all today. If you can, just thumbs up, put a like on the video, and you are a hero if you listen to all the video. But for what I see, of course, when it's stuff that it's complicated and it's not so simple, and it doesn't have an attention span of 10 seconds, and it's not pushed forward by the algorithm YouTube, so that means that I'm doing a good work. And okay, thanks a lot, and see you with more material to the next episode.